Welcome to Economic Trends, your source for the latest news and analysis on global economics and business. On the morning of November 2, 2022, the value of FTX, a cryptocurrency trading firm, was worth $32 billion. However, within a few minutes, everything fell apart. An article by CoinDesk revealed that Alameda Research, FTX's trading firm, held $5.1 billion worth of FTT tokens, which was FTX's flagship cryptocurrency. Although subtle at the time, this was the beginning of the end. On November 6th, the CEO of Binance, CZ, announced that he would be liquidating $2.1 billion worth of FTT tokens, which was a declaration of war. CZ had just discovered that Alameda Research was not only tied to FTX, but practically was FTX. If he could make Alameda Research sink, FTX would go down as well. As the FTT token began tanking, the value of Alameda Research's assets plummeted, and hundreds of millions of dollars were almost instantly withdrawn from FTX. This was the beginning of the bank run that officially started. By the end of November 6th, over $5 billion worth of assets were withdrawn from FTX, leaving only a little over $1 billion in cash left for customers to withdraw. The CEO of Alameda Research, Caroline Ellison, tweeted, "CZ, if you're looking to minimize the market impact on your FTT sales, Alameda will happily buy it all from you today at $22. However, CZ knew this was a sign of weakness, and rather than taking on Alameda's offer, he stated, "I think we will stay in the free market." The CEO of FTX, Sam Bankman-Fried, SBF, was in shock. CZ was about to destroy SBF's entire career within days. As the withdrawals continued, SBF frantically tweeted that FTX was fine and that assets were fine. These were all lies, but SBF was desperate to stop the withdrawals now or the credibility of FTX would be tainted forever. SBF further soothed the crowd by saying that FTX had enough to cover all client holdings and that they had been processing all withdrawals and would continue to do so. Again, these were three more lies. FTX did not have enough to cover all client holdings. They invested client assets, and they were not going to continue processing all withdrawals. By Tuesday, November 8th, $6 billion had been withdrawn from FTX, and users were trying to withdraw even more money, but FTX simply didn't have the cash on hand. The numbers on their screen were all a facade, and SBF had no choice but to give in to CZ's demands. In a shocking turn of events, SBF called CZ with an offer to sell FTX to Binance. CZ saw this as a modern opportunity to become the Rockefeller of crypto. FTX was the number 2 exchange by volume, and Binance was the number 1 exchange. If CZ were to buy FTX, he would not only become a crypto giant, but also the crypto monopoly. However, after taking a closer look at FTX's financials, CZ was appalled by several red flags. SBF was committing fraud. In order to understand why CZ was so horrified by FTX's financials, we have to rewind all the way back to how SBF started FTX. Shortly after graduating from MIT, SBF began his career as a quant trader at Jane Street Capital, where he gained experience trading ETFs. This experience set the stage for the founding of Alameda Research. Market makers like Jane Street aimed to buy and sell identical assets near the market price, providing liquidity to buyers and sellers. As a trader at Jane Street, SBF recognized the potential for huge profits by applying market-making strategies to the cryptocurrency market. However, he faced a major obstacle: the lack of infrastructure in the crypto space that would enable efficient trading. To overcome this challenge, SBF decided to build his own crypto trading platform, FTX. To fund the development of FTX, SBF turned to his former employer, Jane Street. He convinced the company to invest $10 million in his new venture in exchange for a 10% equity stake. With this funding, SBF was able to build a state-of-the-art trading platform that would become one of the largest and most advanced in the crypto space. But there was a catch. In order to attract more investors to FTX, SBF needed to create the illusion of liquidity. He did this by artificially inflating the trading volumes on his exchange, using a technique called wash trading. This involved buying and selling the same assets back and forth to create the appearance of real trading activity. SBF also created fake accounts and traded with himself to make it look like there was more demand for FTX's services than there really was. This strategy worked, at least for a while. FTX was able to attract more investors and expand its business rapidly. But the truth was that FTX's trading volumes were mostly fake, and the company was not as profitable as it appeared. When CZ looked at FTX's financials, he quickly realized that something was amiss. He saw that FTX was reporting inflated trading volumes and that its profits were not as high as they seemed. He also discovered that FTX was heavily invested in risky assets, such as derivatives and leveraged tokens, which could potentially wipe out the company's entire portfolio in a market downturn. CZ knew that he could not acquire FTX under these circumstances. He declined SBF's offer and instead chose to focus on Binance's own business. FTX, on the other hand, was left in a precarious position. Its trading volumes and profits were exposed as fake, and investors began to flee. Within a few weeks, FTX's value had plummeted to just a fraction of what it was before the news leak. SBF's greatest venture was about to begin. Within 6 months of launching FTX, Binance's CZ reached out to SBF, recognizing the potential of FTX and offering to purchase a 20% stake in the exchange for $100 million in October 2019. SBF saw this as an opportunity to accelerate FTX's growth, as Binance was the largest player in the industry. Unbeknownst to him at the time, accepting CZ's offer would turn out to be his biggest regret. In FTX's first year, Alameda Research played a crucial role in the crypto exchange's success. Almost half of the trading volume on FTX was thanks to Alameda's market making. Market making involves buying and selling the same asset at different prices to speed up the time for trading. However, SBF knew that the dependence on Alameda was not ideal in the long run due to various conflicts of interest between the two companies. It would be strange, if not illegal, for Alameda to gain access to FTX's proprietary trading data. Despite this, the two companies continued to operate as if they were one. To avoid regulations set on cryptocurrencies, SBF and his team set up a complicated corporate structure. Instead of creating only 2 entities, SBF and his team created a series of entities that would be difficult for accountants to follow. For example, Alameda Research had multiple entities, including a British Virgin Islands entity called Alameda Research Ltd. And a U.S. entity called Alameda Research LLC in Delaware. This structure allowed SBF to engage in illegal activities through Alameda's British Virgin Islands entity while still operating in the U.S. Although SBF is intelligent, he can also be extremely lazy, once admitting that he would frequently play League of Legends while on phone calls. This laziness would soon be his downfall. In May 2021, FTX was applying for a license in Gibraltar, and one of the requirements was a request for information from its major shareholders. CZ was one of these shareholders, having purchased 20% of FTX just a year and a half prior. From May to July 2021, FTX contacted Binance over 20 times for various details about CZ, including information about his sources of wealth, banking relationships, and Binance ownership. FTX received no response from Binance, and by July, SBF had had enough of CZ's lack of response and bought back CZ's stake for a staggering $2 billion, mostly paid through FTX token, the FTT token. This move set the stage for CZ to have an advantage over FTX later on. In July 2021, Caroline Ellison, SBF's alleged romantic partner, was appointed as the CEO of Alameda Research. SBF had recruited Caroline from Jane Street, believing that she would be able to run Alameda without issue. However, Caroline's consistent use of amphetamines, also known as Adderall or Ritalin, made her an incompetent CEO. In addition, Caroline publicly stated that she only used elementary school math. I used very little math. Used a lot of elementary school math, like arithmetic, probability, but not really any of the advanced stuff I learned in college. SBF aimed to attract retail investors to FTX and solidify its credibility by ranking among the top crypto exchanges. Since FTX was a relatively new firm, SBF needed to pass an audit by an accounting firm to accomplish this. However, SBF chose to work with Metis, the first accounting firm in the metaverse, which sounded like a ludicrous decision. Metis operated in Decentraland, a metaverse where people buy and sell virtual land. In conclusion, the downfall of FTX was caused by Alameda Research's ties to FTX and its holdings of FTT tokens, as well as SBF's fraudulent business practices. CZ's decision to liquidate FTT tokens and withdraw his assets led to a bank run on FTX, exposing the company's lack of liquidity and fraudulent practices. SBF's attempt to sell FTX to Binance failed due to CZ's discovery of the company's financial red flags, and FTX's future remains uncertain. This story serves as a cautionary tale of the dangers of fraudulent business practices in the cryptocurrency market. Don't forget to subscribe and enable notifications to stay updated on future developments in global economics and business. Until next time.